Welcome to the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. So today I've got great pleasure in introducing Arthur Kemp. Arthur, thanks for joining us.
My pleasure. How are you today?
I'm really good. How are you doing?
Yeah, good. Start of another busy week, but all good.
Excellent. So Arthur's here to talk to us about capital allowances. Now, this is a huge tax perk that commercial property has that residential doesn't. Or at least most residential doesn't. There's always a depends, isn't there, with tax, but most residential doesn't. And so I really wanted to get Arthur on here, and because it's so important, and I think it's such an area of commercial investing that so many people don't know about, or at least don't know the necessary level of detail in order to take advantage of this. So before we start on that, Arthur, would you like to give us a quick intro, and then we'll go straight into it?
Yeah, thank you. My name's Arthur Kemp. My company is Exact Capital Allowances. I've been working with capital allowances for about 20 odd years now. I first kind of came to it when I was working for a big sort of international company who had lots of big blue and yellow stores around the country, and they weren't advised properly on the intricacies of capital allowances. And I saw this really as an opportunity, because a lot of investors, whether you invest in commercial property or some other types of property, they can benefit from this tax relief. And it's not something that a lot of people know about. Sure, your accountant will know what capital allowances are and how to transact them, but actually what's behind the detail is kind of the interesting bit for me anyway. So very, very briefly, in sort of simplistic forms, capital allowances relates to tax relief that a property investor can get for items known as plant and machinery. Now, plant and machinery might sound like diggers and tractors and that sort of thing, it is plant and machinery. But in a building, especially commercial buildings, there's items which you can claim tax relief on. And this plant and machinery is typically all of your second fix items, all the electrical installations, all mechanical installations. So from a commercial property that we were talking about earlier, for example, that had Cat 5 installations, so people can use the networking system to access computers, had a heating system, it had security installations, so CCTV, for example, roller shutter doors, and there, even white lining in the car park. You can claim for a whole host of these sort of things: sanitary ware, kitchenware, anything that's fixed to the property, that's not structural, but makes the building work. That's what you can claim for plant and machinery. Also, though, since 2018, you can actually claim for the structure of the property. And this was something that was introduced to bring us in line with how tax is treated in Europe. Even though we're outside of the EU, we're sort of treated the same in terms of the tax structure. So what that means is anybody who's buying a commercial property, not only can you claim the value of the plant and machinery, which is, let's say, 20-25% of the purchase price, you can also claim a tax deduction for the structure side of the property. And of course, that's the majority. That's 45-50% of the building that you actually buy. And the only thing that you can't now claim tax relief on is the value of the land. So as part of the process, every purchase that you buy, we kind of break that down into three parts. We have the value of the land that you've bought, that the building sits on. You can't claim tax relief on that, or rather not immediately. I'll come on to that shortly. You can claim tax relief for the structure, the value of the structure of the property, and then you can claim tax relief on the plant and machinery. So of your £100,000 purchase, probably 75%, £75,000 of that you can get tax relief on. And it's an amazing tax relief, which not many people know about. So it's always something to think about when you're considering a purchase as well.
Fantastic. And as you say, I think it's so few people know about this, and it's such, it's basically leaving money on the table if you don't claim this stuff. So Arthur, tell us exactly how it works. So you say there's like 75% potential capital allowances. You don't need to tell us the exact calculation, but kind of what would that equate to in terms of a tax relief, and when can you claim that? Kind of how long a period can you claim that over?
Yeah, so depending on how long or when you bought the property, that's the important factor. So if you were to buy a property today, you can claim all of the plant and machinery in this current tax year. So if you bought a £100,000 property, keeping the math simple, you could probably claim 25% of that as the plant and machinery value. So £25,000 you can claim as a tax deduction against profits in this current year. That's the first thing to do. You will also be able to claim structure and buildings allowance as well. Now, structure and buildings allowance was the biggest tax relief, but it's claimed over 30 years. So of that £100,000 property that you buy, there might be £50,000 worth of tax relief, and you get that over the next 30 years. It's very similar to an old tax relief people may be aware of called industrial buildings allowance or agricultural buildings allowance. It's something that is based on the price of the property, and you get tax relief over a certain period of time. IBAs used to be 50 years, I think, whereas structured buildings allowance is 30 years. But if you're looking for a long-term investment, imagine the value that 75% of the purchase price of the property is tax deductible. I said you can't claim anything on the land. However, there is something also called land remediation relief, and that's a tax relief associated with buildings or land that may be contaminated. So if you buy a contaminated land or building, it may be contaminated with asbestos or hydrocarbons or naturally occurring elements. Any money you spend cleaning up that contaminated land or building, you can claim 150% of that as a tax deduction. And that's on top of your regular capital allowances you can claim. So land remediation relief, also very interesting, a very valuable tax relief as well. Certainly if you're buying properties which other people may be scared of or walking away from because it's got asbestos or Japanese knotweed or that sort of thing. So that's kind of the value of capital allowances. They can be claimed straight away in your current year tax return. And it's also a great year, especially if you're a great tax relief if you're building up a portfolio, because you may have other properties in your portfolio that have been set up, they're established, they're making profits. And of course, you've got lots of tax to pay on your profits. So a lot of people buy properties that attracts the capital allowances, and they can use those allowances against all the profits from their whole portfolio. So continually buying properties is another great way to not pay tax this year. It's a legal tax relief. It's legislated for in the Capital Allowances Act 2001. So it's a great way to stop paying tax for the time being and sort of push it back to the future once you've used up all of your capital allowances on your purchases.
Yeah, and I know people who maybe are planning a big portfolio sale, because you can claim capital allowances in your own name, or you can claim it in a business, can't you, depending on where you buy it. And I know people who are planning a big portfolio sale who are actually planning to buy commercial property where they can maybe target, we'll talk about in a minute, like certain owners, previous owners who maybe haven't been able to claim capital allowances, so that they can actually offset some of the capital gains tax or corporation tax associated with that. That is definitely a strategy to do. But let's go back to basics, Arthur, and talk about, so if you're looking at a commercial property, practically, so you think it's tax, you've had an offer accepted, kind of when do people need to engage you, and what will need to happen before and after you purchase to get all this stuff claimed?
Yeah, well, I think that one of the important things to be aware of is that you can only claim capital allowances once in a property's lifetime. So if you're looking at a commercial property, obviously the deal's got to stack up and it's got to make the right yields for you. The next kind of question is, oh, well, okay, has the previous owner, the person you're buying from, have they claimed any allowances on the property? And this is where it can get a bit tricky, because some rules came in 2014 that said that if you're going to buy a property that attracts capital allowances, you have to agree that value with the previous owner if they could have claimed the allowances. Now, this is where it's really useful knowing who you're buying the property from, because if you're buying the property from somebody who is outside of the scope to tax, maybe it's a charity, maybe it's a trust or a pension or the local authority, they don't have anything to do with sort of income taxes. Therefore, you automatically get the right to claim those capital allowances. So knowing who you're buying the property from is the kind of the first point. And I would say, if you're at that stage, even before you sort of agree terms or go through the exchange process, it's always best to have a conversation at that point there, just to establish whether or not capital allowances might be available to you. It might be you're getting the property for such a good price that the actual tax relief is negligible or is not really relevant because you're getting such a good deal. That's perfectly fine. But at some point, there's going to be property purchase where the capital allowances will make a difference in terms of maybe offsetting future profits from that particular property. So it's always useful to know who you're buying the property from. The way that the sort of legislation works is that if you're going to claim capital allowances, you have to get that agreement with the seller. Now, the process there is ideally have a conversation before you enter into a contract. We can get a small clause put into the sales contract, which effectively forces the seller to hand over the rights to those capital allowances. If they have claimed the capital allowances, and we probably see probably 1 in 40 or 1 in 50 purchases where the seller has claimed, that'll be all over the contract. There'll be all sorts of elections and restrictions on you, the new owner, being able to claim. That's because the seller's been advised properly, they've claimed their tax relief, and that means that you won't be able to claim anything on the purchase. You can still claim on the development works afterwards, that's fine, that's new expenditure, but on the purchase, then the capital allowances may not be available to you. You can obviously renegotiate the purchase price maybe, but it's also it's interesting to kind of try and establish if the sellers have claimed any tax relief. Unfortunately, there's no sort of database to do a search to say, yes, these sellers have claimed, or no, these sellers haven't claimed. But by sort of asking questions specifically in the CPSE inquiries, if they come back with any useful information, or asking questions of the seller in terms of, are there any sort of tax reliefs available? Have you had any property surveys done that we should know about? Then in terms of our involvement, the sooner the better, to be honest. We can look at how a property has maybe been held by a property or by a person or a company to see the availability of any tax relief. But it's really important, if nothing else from today, just take away the fact that you can only claim capital allowances once in a property's lifetime. And hopefully that'll be you. Otherwise, the previous owners may have claimed them. But there's a definite compliance process to go through when you're looking at. So in terms of contact, as soon as you're looking at buying a property, that's the ideal time to have an initial conversation.
Perfect. And when I was in the corporate world, or if you're buying from a really sophisticated institutional investor, we used to be very upfront in our heads of terms when we were purchasing. In the corporate world, just for the avoidance of doubt, capital allowances will be claimed by the purchaser. That used to be a line in every heads of terms, and the other side absolutely expected it. They'd actually, because they were sophisticated investors, they'd probably claimed it anyway. But we would be upfront. If you're dealing with and I'm going to come to this mind-blowing stat that Arthur's told me before about how few people claim capital allowances. But yeah, if you're dealing with a smaller investor, obviously you want to be a little bit more subtle about it, I would say, because that maybe they haven't claimed it, because they can still go back and claim it, even if you up to the point of purchase, Arthur, or after purchase, they can go back and claim it.
Yeah, so you've got 2 years from the completion date to actually make a claim for capital allowances, or to get the seller to agree to it. And very often it's the case where there's a negotiation that happens, the contract happens, and it's something that's raised and the seller is made aware of capital allowances, very often they don't really understand what claiming capital allowances means, and it looks like there's some sort of like tax issue that they are kind of scared of, really. You don't want to put a contract or clause in the contract which mentions anything to do with tax. They think it's a liability. So very often they just want to proceed and exchange and complete without any references to capital allowances because they see it as a risk. And so that's absolutely fine. You can still go ahead with the purchase without any reference to capital allowances, as long as the agreement is made within 2 years of the completion date. Then you're able to maintain that. Obviously, the seller is more motivated when you're discussing with them and you're negotiating with them. They're more motivated to agree to capital allowances or valuation at that point. But if they don't want to go ahead with it, there's still a couple of processes you can go through. We can still, after completion, contact them and ask them to agree to the capital allowances valuation. We can always escalate it as well, specifically if it's fairly high value. We can start a first-tier tax tribunal, which sounds pretty scary, but in reality, it's just an administrative process whereby we have to provide some evidence to the tribunal to say, here's the seller, here's the buyer, here's the contract, here's our valuation of what the plant and machinery value would be. The tribunal then writes to all the parties involved, including HMRC and the Valuations Office Agency, and they make a judgment based on all the information that people provide them. So that's a process to go through. And if the seller is not sort of wanting to engage or wanting to agree anything to capital allowances, that is still the sort of process to go through there. So it is quite important that you can only claim once in a property's lifetime. Getting that agreement with the seller is important as well. And that's if they have claimed tax relief. If the seller couldn't claim tax relief because of their tax status, then you automatically get those as well.
Yeah. And what's this HMRC stat? Tell us all what percentage HMRC themselves say of people.
Yeah, so this was probably going back sort of 5 or 6 years now, but the Revenue issued a statement to say that 96% of all property transactions hadn't maximised their capital allowances. 96%. Even if you take out all the properties that don't qualify for capital allowances, that's still a huge opportunity for property investors. And I think you've got to ask the question: well, why? Why is it so high? Why is this? Why don't people know about capital allowances? And the main reason is twofold, I think. One, most people assume that their accountants do the work, and the accountants know how to go to site and value all the qualifying items. But of course, most accountants don't do that. They know what capital allowances are. They know that if you give them an invoice for a new air conditioning system that you put in, they know that's plant and machinery, and they'll claim that properly. But they certainly won't go to site when you've bought a second-hand property and go around and count all the light bulbs and sockets and toilets and everything else and provide a valuation for those items. That's what they don't do. And the second reason why I think that a lot of people miss out on capital allowances is, HMRC themselves, they don't phone you up when you've done your tax return and say, oh, Suzi, you haven't claimed your capital allowances. Make sure you do that before you send us your tax return. They're very reactive. They're not very proactive. So therefore, if people don't know this tax relief is available, then people don't claim it simply. So I've sort of spent the last 20 years of my life explaining to people that this tax relief is available and it is legitimate and it does apply to your particular property. And HMRC don't do that. So that's kind of the reason why so few people actually claim capital allowances.
Yeah, I mean, that stat always absolutely blows my mind. So it's staggering.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
Right, so now let's talk about pensions. So a lot of people I work with and a lot of people listening to this will be looking to invest in commercial property in their self-administered pension scheme, their SIP, so their SAS or their SIP. What's your advice vis-a-vis capital allowances with regard to pensions? Because obviously the whole beauty of pensions is that it's a tax efficient structure, but obviously does that therefore mean that you can't invest in you can't claim your capital allowances if you invest in a SAS, Arthur?
So a lot of people look at capital allowances, the benefits, of course, but in order to benefit from that tax relief, you have to be a UK taxpayer. So most people, when they set up a property investing company, they either set up a limited company or they invest in their own names. And that's perfectly fine. If you're the owner of that property, then you're entitled to claim capital allowances, and obviously that offsets any income profits that you make from that particular enterprise, and therefore reduces the amount of tax that you have to pay. Very straightforward. You can think about capital allowances as an extra business cost, if you like. It just makes an adjustment on your tax return, not in your accounts, just in your tax return to reduce profits. If the pension obviously owns a commercial property, then the pension is outside of the scope to tax. So therefore, there's no point in the pension fund claiming any capital allowances because it doesn't have income tax to pay anyway. What I think pension funds can do is they can invest in third-party businesses that will then invest in commercial property, and that's really where the tax benefit would be. If they were to have an arm's length agreement with a commercial property company and lend money on that basis, then obviously that legal entity that owns the property will claim the capital allowances to reduce its taxable profits before it would then return the investment with interest back to the pension fund. So pension funds themselves directly can't benefit from tax relief, but obviously any sort of related tax paying entity that they invest in obviously can.
Yeah, and there is a scenario where you can maybe buy in your limited company or your personal name, claim the capital allowances and then move it on. But obviously you need to get some stamp duty advice on that, and you need to kind of get that structured properly. And obviously that's going to be a size and degree, isn't it, Arthur? You know, like if it's going to be 10 grand, you probably wouldn't do that. But if that's going to be hundreds of thousands of pounds, then that might be an advantage to do so.
It's always worth, I think, sort of planning for the future, if you like. If you're going to buy a property in your own name or in a company, benefit from the capital allowances, and then decide to move it into your pension in a few years or split the title, whatever it might be, then that's all perfectly fine. But the downside to that is you might have to pay 2 lots of stamp duty, and then you've got to weigh up, well, is there a benefit for me net or not? Is it going to cost me extra? So all of these strategies are available, but sitting down and planning your sort of future and what you're going to invest in is also a great thing to look at as well.
Yeah, no, I mean, that's a real theme of this podcast, and the way I kind of help clients and where I invest as well is start with the end in mind. And, so whenever we're buying any property, when we're building a portfolio up, we need to be planning our exit, and ideally multiple exits as well. And this all just forms part of that, doesn't it? And as I say, if you are coming towards an exit of one or more properties, especially if they've gone up a lot in value, then buying another property or properties with capital allowances can obviously offset some of that gain. So there's definitely that's and that needs to be planned some way ahead rather than kind of being knee jerk and doing it in the moment. So yeah, always start with the end in mind on everything. So
say though, Susie, sorry, a lot of people, because they're new to capital allowances, they've got their position as they are right now. So they don't know about capital allowances, and they may be accidental landlords, and all of a sudden, I've got 5 or 6 properties. What do I do about that? I can benefit from capital allowances today, even though I've not heard about it before, but there is a benefit to be had today. And of course, once you know about that tax relief, you can plan it for the future.